Hi everybody. This is week 2, and then this is a lecture for topic 1 part 2. Topic 1 of the course is a big topic. So this topic will be covered or is covered in week 1 and week 2. Last week, in the week 1, you have watched the video or the lecture for topic 1 part 1. This week, topic 1 part 2. At the end of this week, we will cover everything in this topic. Okay, in topic 1 part 1, which have been covered last week, you have learned about the definition of accounting, role of accounting, user of accounting information, and then you have learned about the difference between management accounting and financial accounting. And the last thing I think that you have learned in topic 1 part 1 is type of businesses. There are 3 types of businesses in terms of activities. There are service business, merchandising business, and manufacturing business. And then there are 3 types of businesses in terms of ownership. And these 3 types of ownership business is like this: a sole proprietorship business, partnership business, and company. So you have seen that in topic 1 part 1. In topic 1 part 2, which has to be covered this week, the thing that you will see is these 3 things. The first one is you will learn about the components of financial statement. The second thing is elements in the financial statement. And the third thing that you have to learn in this part 2 of the topic 1 is principles and assumptions in the preparation of financial statement. Okay, so remember this. Starting from this week, the focus of the lecture is on the financial accounting. There are 2 main branches of accounting: financial accounting and management accounting. Financial accounting is the accounting that can be used to calculate profit for businesses. If you have a business, you want to calculate your profit, or you want to see the performance of your business, then you use financial accounting. Management accounting is the accounting that a business can use to help the manager to run the operation of the business. For example, to calculate costs and to prepare budget. Okay, so our focus is on the financial statement. On the financial accounting. So, financial accounting, like I said earlier, is the type of accounting that can be used to measure a business performance or to calculate profit or loss for a business. Let's say you have a business, you want to know whether your business is making profit or loss, you use financial accounting. So, financial accounting is a process. You have to remember the definition of accounting. Accounting is a process to analyze and record business transactions and produce financial information. So, financial accounting, the process is analyze and record financial transaction. You have a business. When you have a business, there are many transactions. The business sells something, the business purchase something, the business pay salaries, the business pay rental, the business pay electricity, the business purchase motor vehicle, etc. So these are transactions. So accounting is the process to analyze and record this financial transaction and to report financial information. To report financial information means financial accounting will produce something, will produce a report. In that report, you can see whether the business is making profit or loss. So if you have a business, you want to calculate profit, so you use financial accounting every day. At the end of the year, you can calculate the profit for your business. So financial accounting, the report that is coming out from the financial accounting is called financial statement. So every business out there, if they use financial accounting, they will do the financial accounting activity every day. And at the end of the year, they have to produce the report, a report that contains information about whether the business is making profit or loss. That report is called financial statement. Okay. So that is the first thing that you will learn today. The components of financial statements. So let's see, what is the financial statement? The financial statement, again, the financial statement is the output or the report coming from the financial accounting activity. Okay, the financial statement is like a book. I want to explain it again. You have a business, you use financial accounting every day. You have to do financial accounting activity, which is recording the transaction, etc. At the end of the year, the financial accounting has an output. The output is the report. The report is called financial statement. So in the financial statement, it's like a book. So what are the components of the financial statement? What are the things that you can see in the financial statement? So there are 5 components of the financial statement. First one, it is called balance sheet. Second one, it is called income statement. Number 3, statement of owner's equity. Number 4, cash flow statement. Number 5, notes to the account. So the financial statement is a report. It is like a book. Inside that book, there are 5 things. 5 main things. These are the 5 main things. Okay, let's see one by one. What is the income statement? The income statement is the component number 2 in the previous slide. The income statement is a summary of the revenue and expenses for a specific period of time, such as a month or a year. Okay, financial statement can be prepared every month or every 3 months or every 6 months or every year. But according to the law and regulation, a company must prepare or has to prepare a financial statement at least once a year. At least once a year. But if the company or a business want to prepare the financial statement every or the income statement every month or every 3 months or every 6 months, that is okay, acceptable. But compulsory at least once a year. Okay, so income statement contains the summary of revenue and expenses. So it shows whether the business is making profit or loss. So this is the sample income statement. This is an example of income statement. So income statement shows the performance of a business. In accounting, the performance of a business is seen the performance of a business is measured by whether the business is making profit or loss. If a business in accounting, if a business is making profit, we say that the business is having a good performance. If a business is making loss, then we say that the business is not having a good performance. So this is the income statement. So see here, this income statement is for a sole proprietorship service business. I have told you last week, in this course, you will learn about accounting for sole proprietorship service business. Very simple business. So see here, the income statement is like this. The format, see the format. The format is very simple. First, you have to show the revenue of the business. Revenue of the business is coming from providing services. A service business does not sell anything, so they provide services. So in this sample income statement, see here, the business name is Net Solutions. So in the income statement, the first thing that the business show is the revenue. The revenue of this business in this sample income statement is fees earned. 7,500. That is the fees earned, total fees earned for this November 2007, supposed to be 2017. Okay, so fees earned 7,500, and then okay, that one is the revenue, and then minus expenses. There are 5 expenses: wages expense, rent expense, supplies expense, utilities expense, miscellaneous expense. So the numbers are 2,125, 800, 800, 450, 275, and the total expenses is 4,450. So net income or profit is equal to 3,050. So in accounting, to calculate profit, the formula is very simple. Total revenue, which is 7,500 in this sample income statement, minus the total expenses, 4,450. So you will get the profit or net incomes, the 3,050. Okay, this is income statement. It shows whether the business, it shows the performance of the business. If the business is making profit, we say that the performance is good. If the business is making loss, then in accounting we say the performance is not good. Okay, this is another statement. Another component of the financial statement. It is called statement of honest equity. It is a summary of the changes in the honest equity that have occurred during a specific period of time. So, statement of honest equity shows the changes in the honest equity or in the honest capital. If you have a business, you have to invest capital in the business. So, from time to time, the amount of capital will increase or decrease for several reasons. So, statement of honest equity shows any changes that happen in the equity or the capital invested by the owner of the business. Okay. So the format is very simple. Like here, you can see. Firstly, in the in the statement of honest equity, the report shows the beginning investment or the beginning capital invested by the owner of the business in the business. And then the statement will show any increment in the capital. In accounting, if a business is making profit, then there will be an increase in the capital or equity of the business. And then the next thing see here, less withdrawal. See in this slide, in this sample statement of owner's equity, less withdrawal. So less withdrawal is an item that that will reduce the amount of capital. I hope I can explain about this more later. But today I want you to see the format first. So the third thing that you have to that you can see here in this sample statement of owner's equity is an item that will reduce the capital. So in this example, less withdrawal, 2000. And then the last thing in this statement is the ending balance of the capital. So here, I will explain it again. First, the business, in the statement of owner's equity, the business has to show the beginning balance of the capital. In this example, the beginning balance is 25,000. This is the amount invested by the owner of the business when the owner opened the business. So he or she put $25,000. Okay. At the end of the year, the business is making profit 3,050. So in accounting, if the business is making profit, then the capital or the equity of the business will increase. Okay, the owner invested 25,000. After 1 year, the business is making profit. The profit is belong to the owner because the owner invest the capital. So now, after 1 year, profit is 3,050. So the balance is, now the total capital is 28,050. And then less withdrawal. Withdrawal, like I said earlier, is an item that will reduce the amount of capital. Withdrawal is something like this. At one time, the owner of the business need cash urgently. So the owner take $2,000 from the business. So that kind of situation is called withdrawal. When the owner of a business takes something from the business, so in accounting we call it withdrawal. You will learn about this later. So and then you can see the net total, the beginning balance plus something minus something, then you will get the net amount or the ending balance or balance at the end of the month. So Chris Clark Capital, November 30th, 2007, 26050. At the beginning of the month, the capital balance is 25,000. At the end of the month, the capital balance is 26,050. That is the statement of owner's equity. So you have seen two components of financial statement, income statement and statement of owner's equity. Okay, this is the number 3. And this is another component of the financial statement. So if somebody asks you what are the components of financial statement, the answer are 5. Yeah, you have to check the previous slide. 5 components. We have seen 2, income statement and statement of equity. Now we are seeing balance sheet. Okay, a balance sheet is a list of assets, liabilities, and owner's of equity as of a specific date. Okay, you will learn about asset, liability, and equity after this. So assets are resources owned by the business. If you own a business, the business will have maybe building, furniture, equipments. What else? Maybe land. These are assets. In accounting, we call them assets. Things owned by the business or resources owned by the business. The business will have cash. So cash is also an asset. So balance sheet is a list of all the assets. And liabilities. Liabilities are things that the business has to pay in the future. Now, or in other words, liabilities are also called obligations, things or items that a business has to pay in the future. For example, bank loan, uh, account payable, and several more. Okay, something that the business has to pay in the future. In accounting, we call them uh, liabilities. Owner's equity are the amount or the amount of cash or resources owned by the owner of the business. If there is a business, when the business is started, the owner will have to invest something. So that investment, in accounting we call it owner's equity, amount owned by the owner of the business. You have seen in the previous slide, the owner's equity, the changes in owner's equity is shown in the statement of owner's equity. Okay, so a balance sheet is a list of assets, liabilities, and owner's equity of a business for a specific date. And remember this, a balance sheet shows the financial condition of a business. Okay, let's see. This is the format of balance sheet for a sole proprietorship service business. In this sample balance sheet, the period is 1 month. This balance sheet is prepared for 1 month only. So how to, there are several format for balance sheet, but in this course we use the simplest format. You have to show, in this format, you have to show all the assets of the business in the left side of the balance sheet, and you have to show the liabilities and owner's equity of the business in the right side of the balance sheet. Very easy. Yes. If somebody asks you to prepare a balance sheet, then you know. In the left side of the balance sheet, you have to list all the assets. In the right side of the balance sheet, you have to list all the liabilities and owner's equity. So let's see in this example. In this example, the name of the business is Net Solutions. This is a sole proprietorship service business. So in the balance sheet, the business has to list all the assets in the left side of the report. So assets here, the business has cash 5,900, supplies 5,550, land 20,000. So total assets equal to 26,450. In the right side of the balance sheet, the business has to list all the liabilities and owner's equity. Okay, the first thing here, under the liabilities, the business only has one liability, which is account payable. So account payable is like this. In accounting, if a business owe something to supplier, then that amount that the business owe to the supplier is recorded in account payable. In accounting, we record things in account. Later you will learn about this, but at this point you have to know that account payable is a liability, something that the business has to pay in the future. Okay, and then the owner's equity. See here, the owner's equity is 26,050. So this number is coming from the statement of owner's equity that you have seen in the previous slide. You can check the previous slide. At the end of the month, the ending balance of the owner's equity is 26,050. So just put the number here. So you can see there here, the total number in the left side of the balance sheet is equal to the total number in the right side of the balance sheet. You you will learn about this later. Why number in the left side, total number in the left side equal to the total number in the right side of the balance sheet. So at this point of time or this week, I just want you to see the format for these statements, and then try to see the logic, and later you will learn about how to prepare this income statement and balance sheet. Okay, so the next thing, this is number 3, the balance sheet. Okay, always remember a balance sheet shows the financial condition of a business. Normally or typically in accounting, when we want to know about the financial condition of a business, we look at the liability. Liability means some debts or something that the business has to pay. In general, in accounting, we say that if a business has too many liabilities, then the business not in a good financial condition. If a business is having only small amount of liability, then we can say that the business is in a good financial condition. That is the simple conclusion that we can make in accounting. If a business is having huge amount of liabilities, then the business, we say that the business is not in a good financial condition. If a business has a very low amount of liability, then we can say that the business is in a good financial condition. This is another component of financial statement of cash flows. It shows the cash in and cash out that happen in the business during an accounting period. In this sample question, the accounting period is 1 month, November 2017, supposed to be 2017. This statement, remember, statement of cash flows shows the cash in and cash out that happened in this business in the month of November 2017. And then component number 5, in the financial statement, is called notes to the account. Okay, we'll explain about notes to the account. Notes to the account shows the detail about the item that have been listed in income statement, balance sheet, statement of equity, and statement of cash flow. Okay, remember, notes to the account, which is the component number 5 in the financial statement, shows the detail for every item that has been listed in the income statement, statement of honest equity, in the balance sheet, and also in the cash flow statement. The thing that can happen is something like this. Remember, in the balance sheet, the only liability of the business is account payable. So, in the balance sheet, the business right there under liabilities in account payable, and it has an amount. In the notes to the account, the business has to list the details, how many suppliers they owe money. Let's say this business, let's say for this business, this sample business, the account payable total is 4,000. I cannot remember the correct number. Let's say it is 4,000. Then in the notes to the account, the business has to list for this 4,000 how many suppliers that the business owe money to. Maybe suppliers A 2,000, suppliers B 1,500, supplier C 5,000, 500. So the total is 4,000. So something like that. Another example is like this. In the balance sheet, the business right there that the business has a piece of land. Uh, the business has asset land. The value of the asset is 20,000. So in the notes to the account, the business has to provide the detail. How many? Maybe the total land value is 20,000, but the business has two pieces of land. The first piece of land, the value is $15,000. Another piece of land is $5,000, for example, maybe. That is the notes to the account. So just remember, you have seen in this section, there are 5 components of financial statement. The first one is income statement, and then statement of equity, and then balance sheet, and then statement of cash flow, and then notes to the account. 5. But in this course, you will learn about how to prepare 2 components only. You will learn about how to prepare an income statement for a business, and also how to prepare a balance sheet for a business. So focus on income statement and balance sheet. Okay, I will explain or do lecture for this subtopic in the next video. Thank you very much. Do not forget to write your name and metric number in the comment sections so that I can take it as the attendance for this lecture. For this lecture, topic 1, part 2, lecture 1. Thank you very much again.